Does it feel like no matter what you do and how perfect you are with your home insurance, that rates continue to rise? Well, you're not alone. Nationwide, rates are rising at an alarming rate. It doesn't matter if you're in Montana enjoying the beautiful elk, looking out from a high rise in New York City near Madison Square Garden, or enjoying the salty air near the beach in San Diego. Home insurance rates are increasing nationwide at an ever increasing rate. I am Max, a licensed insurance broker since 2014. I have seen the good, the bad, and the ugly of the industry, and I'm here to share some secrets that you only get from doing this for quite a long time like myself. So hopefully you never have to use your insurance, but it's way better to be prepared than not prepared. I'm also here to help you save money so you can spend money on things that actually matter because, to be honest, insurance is pretty boring. Before we tackle how rates have increased so much since just last year, let's bring it back a few steps and look at this whole picture full circle. In the 5-year period from 2018 to 2023, the US as a whole saw rate increases of 19.1%. However, there were 3 states in particular that were absolutely hammered the most. Florida, South Dakota, and Arizona all increased respectively 41.5%, 36.8%, and 35.5%. Think about that. Even if you're a perfect homeowners insurance customer, which means never filing a claim and never using the insurance. In 2018, in Florida, you were paying $2,000 a month, let's say. By 2023, you were paying $2,900 a year. And again, this is with never filing a claim and never using the insurance. That really stings. All right, so that's what's happened in the past. Now let's talk about today. In just 1 year since 2023, we're in 2024 now, nationwide, rates have increased 23% just in 1 year. Looking at this map here, generally speaking, the states that have more occurrences of natural disasters have higher premiums. You'll see the bluer the state, the cheaper the home insurance, and then the red states obviously show the hotter and more expensive. So if you were in the blue, congratulations. If you're in the red, buckle up for the next couple years as well. All right, so that's all about last year, 5 years ago, which is all fine and dandy, but the reality you're watching this video is how to save on your homeowner's insurance. Let's face it, nobody likes insurance except weird people like me. However, no one wants to spend more on insurance than they have to each year. So here are the 5 ways to decrease your home insurance premium right now. All right, number 1 way to save on insurance is to shop around. This may seem really obvious because most people, I would think, shop around for most things. However, over a quarter of people in general don't ever shop their insurance around. They simply just accept what's happening. So think about that. 26% of people never shop multiple quotes. And then here's the kicker. When people do shop around, they save 76% of the time. So over 3/4 of people save when they shop around. There are really 2 ways to shop around your insurance. The first approach is what I call the DIY, do-it-yourself approach. All right, so go to your favorite search engine and type in home insurance company in your state. You can then go to each insurance company's website and type in the same information between 1 and however many times you want. Some will give you a quote immediately, and sometimes you can even pay for it right there online without talking to somebody. And then others will want to put you more through a process and want somebody to reach out to you via email or via phone. It's rather inefficient because, again, you're typing in or giving the information to somebody each and every single time. Again, the exact same information. And the moment you click the Get Quote button, I can pretty much assure you that their terms of service are going to give that information to not just their one insurance company, but probably all their affiliates, which could be half a dozen or even up to a dozen different companies. So instead of just having one insurance company reaching out to you for quotes, you may have a bunch that really are probably not what you want to do. And they're probably going to sign you up for marketing purposes as well. So your email and then phone number are then going to be inundated with a bunch of junk that you simply don't want to deal with. Very, very inefficient. However, there is a second way that is far more efficient and way better for you. If you were going to court and you needed to have some legal representation, would you trust yourself to understand the procedures and everything in the courtroom? Or would you hire an attorney? I'm going to guess most people would hire an attorney. The exact same thing can go for insurance. So instead of you doing the do-it-yourself approach, and to be honest, you really, as someone who doesn't work in insurance, really understand what you're purchasing, the reality is insurance is rather complex. And just like my law example, my example in the courtroom, you're going to want a professional to help you through the process. So option number 2 is utilize a professional. And these professionals in the insurance world are called independent agents. And independent agents are just that. They are independent. They do not have exclusivity with any one insurance company. So that means they can shop around at many, many different carriers and find the best deal for you. They do the heavy lifting, and you're going to give, again, the information to one person. They then go through all the different carriers and find the best solution for your situation. So I recommend reaching out to a few in the area, maybe 2 or 3. And again, same thing, search on your favorite search engine, independent agent near whatever city you're in. I can assure you this is far more efficient, and you're likely going to find a lot better deal than doing the DIY approach. All right, number 2 on how to save money on your insurance is to increase your deductible. A deductible, really simply put, is the amount you have to pay before insurance starts. The reason insurance companies have this is because many times there's going to be small issues that are not going to be insurance-related events. So let's give you an example. So if you have a pipe burst and you find it in time and it only costs, let's say, $200 to replace, the reality is you're not going to involve insurance over $200. You're simply going to pay that out of pocket. So deductibles make sure that you as the consumer don't abuse the insurance system for all these small claims that in reality is just the cost of owning a home. Most insurance companies default to a $1,000 deductible. However, you can increase that to $2,500, maybe even up to $5,000, and that may have some substantial saving. I've seen people who take their deductible from $1,000 to either $2,500 or $5,000 have savings of up to 30%. And that may be the only thing you have to do to decrease your premium significantly throughout the year. Yes, obviously that means if something were to happen to your home, then you'd have to pay up $2,500 or $5,000. The reality is most people with home insurance specifically don't use it often, if ever. So you'll have to figure out what your risk tolerance is. Most people who are good insurance consumers don't use insurance very often, if ever. You know, the reality is if the house burns down, obviously that's when you use insurance. But for all these smaller items, the reality is increasing the deductible over time can help you self-insure. Now, what does self-insure mean? That just means if you increase your deductible from $1,000 to $5,000 and your premium goes down by, let's say, $500 a year, that means that $500 a year, you're then going to put in your pocket and keep that for in case there's something that needs to be done on the home. So congratulations, you are now officially your own insurance company, kind of. All right, number 3 is decrease your coverage. And this is a very, very sensitive subject and should be taken very, very lightly and very, very thoughtfully. It's kind of like if you were to order something fragile through the mail. They're going to put on the package, hopefully, fragile or handle with care. When you are decreasing coverage, you want to definitely handle with. Often, home policies have what's called an inflation guard, which means it automatically increases your coverage between 5 and 7% each year, no matter if you request it or not. It's simply built into the policy. All right, so let's say on year 1 of buying a home, the home coverage you have is $350,000. In 5 years, if you have an inflation guard, which again, a lot of these policies do, that's going to increase your coverage to almost $450,000. So this is why having a professional agent look at what's going on is very, very useful. Because the reality is, this can open a conversation on, well, over the last 5 years, has your home value as in not the market value, but the rebuild value. If the home were to burn down tomorrow, how much is it going to cost to rebuild? And there can be a conversation about, is that a appropriate increase? Sometimes that increase is justifiable based upon the area. If you're in a locale where it's very, very expensive to build homes, then that increase may be warranted. A lot of times, though, it is simply not warranted. And you're probably thinking, well, that's great. If my insurance increases, that means if my house burns down, they pay that amount. No. The insurance company is only going to pay the amount that it costs to rebuild your house. So if your coverage is almost $450,000 and it only cost $350 to build your home, the insurance company is only going to pay $350,000. They're not going to cut you a check for almost $450. I know that's unfair, but the reality is that's simply how it works. So you're paying extra premium for nothing. Besides the home dwelling coverage, which is if your house burns down, that's how much they're going to pay out maximum to rebuild the home, you also may consider looking at the other structures, the personal property, or the loss of use. Other structures is pretty self-explanatory. It's any structure, as in a shed, a pool house, in-laws quarters, anything that is separate from the home. So that could be something as simple as a detached garage. Anything that's attached to the home would not be part of the other structure. Many times it defaults to 20% of your home coverage policy. So if you have $350 of coverage, $350,000 in home coverage, it's going to automatically be $70,000 in other structures coverage. If all you have is a utility shed in the back from a home improvement store that costs $10,000, you definitely do not need $70,000 in coverage. That may be able to be reduced. Next would be personal property. That would be furniture, clothing, anything not high value, and anything that would be, if your house burned down, to replace. Fridges, appliances, anything of that nature. Typically, this is 75% of your home coverage. So on $350,000, the coverage for personal property, which again is furniture, clothing, anything not high value, would be $262,500. So you think to yourself, do you actually have that much personal property in your home? If the answer is yes, great, leave it be. The answer is no, usually, because most people don't have that much stuff. Scratch that. They may have a lot of stuff, but it may not be valued at, over $250,000. So that value can definitely go down for most people. And then lastly is what's called loss of use, which is just a fancy term if your house burns down and you have to go live in a hotel or have some short-term living arrangements and expenses while the home is being rebuilt. That's what loss of use is. That is typically about 20% of the dwelling coverage. So again, $70,000 on a $350,000 policy for the home. So you think to yourself, if I had to have my home rebuilt after it burned down, it's going to take between 12 and 24 months. Figure out how much the monthly rent on a home similar to yours in your area would be. You take that figure, multiply it by how many months it is, and is that more or less than $70,000? If it's more, then you may consider increasing the coverage, but if it's less, you may consider decreasing it. All in all, insurance companies always increase coverage. They typically never decrease the coverage, so you definitely want to keep an eye on whether or not these increases are appropriate. All right, number 4 is, have things changed recently? Often companies have add-ons or extras that simply don't apply anymore or never applied. These add-ons are called riders because the reality is if we were in a train, there would be the normal home policy, and then riding next to it would be these add-ons. So they call them riders. So think about these several things, whether things have changed or not. Do you have any art? If you did you sell it? Jewelry, same thing. Is it sold? Do you still have it? Earthquake. What's the likelihood of an earthquake hitting your area? Flood. Again, what's the likelihood of a flood hitting your neighborhood? Home business. Were you self-employed and now you're working a normal job again, a normal 9 to 5 for an employer? And then lastly would be building code coverage. Definitely not needed for newer homes that are up to code. And that's the one that's a little weird because if you have a home that's built with, say, what's in the last 15 or 20 years, sometimes companies automatically put on the building code coverage. And again, pretty much every single line item on an insurance policy has a dollar amount tied to it. Which means if your house is 15 years old and let's just make believe half your kitchen was destroyed in a fire, the reality is they don't need to increase the level of building because everything is already up to code if it's rather new. Again, very, very good questions and points to bring up with a professional. Number 5 is to bundle your policies together. Often, simply by going with the same insurance company or insurance carrier, you can save between 10 and 20% on each individual policy. So if you have your home, auto, you can save 10 to 20% on each individually. And if you have an umbrella, life, or small business policy, again, the more policies you put with one individual carrier, oftentimes there are very, very strong incentives to put them all together. What's nice about bundling the policies, it's very, very simple. Usually it's one bill, one insurance company to deal with, and it makes it very, very more efficient for the agent as well as you. Having several insurance companies, insurance carriers can be very overwhelming and very, very annoying to do. Number 6 is, does the insurance company or agent have the correct information about your home? Details about the home in general are initially put in by the agent or the insurance company who wrote the policy, which means there's always going to be human error involved. I one time saw a home that was built in the mid-'80s, and it said the last time the roof was replaced in the mid-'80s. The reality is the roof was actually really replaced about 5 years before the policy. So the reality is roofs in general are the one thing that insurance companies are very, very particular about. So an old roof means that it's more likely to cave in, more likely to catch on fire, more likely to simply be destroyed in a weather event. So I was looking at this and thinking, wow, if that's really the case, then we need to update that. Upon updating it by someone else's mistake, the homeowner saved 10% on their policy, like a snap of the fingers, just because the information was in. That conversation was not fun to have, to be honest, with the client, but the reality is it's these small details that really do matter with insurance. Another one I saw was, according to the insurance company, there was a pool in the backyard. And after years and years, nobody saw this. But the reality is, the insurance company initially, just so you guys know, insurance companies spy on you, so they take the maps view and they see a satellite over your house. And they see what's going on in the backyard, everything, all the details they can see publicly to see whether they want to insure your property or not. So the insurance company did this and did the satellite view overhead and saw that, oh, there's a pool in the backyard. But you want to know what the reality of the situation was? Is that they were looking at the next door neighbor who has a pool, and this homeowner, who has a policy through me, did not have a pool. So again, it may be agent wrong, it may be insurance company wrong. The reality is, as a consumer, you have to advocate for yourself, and the only way you can do that is by preemptively and looking at this every so often, because the reality is mistakes do happen. Just don't let this mistake happen to you. Some of the changes that may have occurred are, it's a lot of homes, there are chimneys and fireplaces. A lot of people will remove those. Have you removed one? If you remove that, likely going to be some savings there. And then lastly, did you install a security system with central monitoring? If you install the security system, again, probably going to have some savings. All these things would be best communicated to the agent. All right, lucky number 7, and this is the last one for the video, is to rinse and repeat, which means do this every couple of years. Don't be that naive person who believes everything is going to work out exactly as it should be. Yes, believe that in other areas of life, but not with insurance. Insurance companies are going to do everything they can to increase your coverage, increase the premium, to increase their profitability for their shareholders. And that's not to say that's a bad thing, it's just the reality. Companies want to be profitable, and the way they do that is continue to upsell, upsell, upsell. So you have to advocate for yourself. And this is when having an independent agent is so very, very important, because if they're a really, really good agent, every couple of years they should be giving, or every year really, at every renewal, they should be giving you an analysis on whether or not it is a good idea to quote different quotes for your current policy. The reality is, if there was a 1% increase, there's probably no need to go for multiple policies. But if your premium increases by 20, 25, or 30%, then it's likely going to be a very, very good idea to compare other rates. All right, so those are the 7 ways to decrease your home premium. I want to know, though, in the last few years, how much has your insurance gone up since you've bought your house? I know for my one house in Texas, the premium went up by at least 30% each and every single year. And again, I do the exact same thing with my guy. I say, hey, independent agent, can you look at, see if there's any other options? And every year I've done that, it comes back with a 5 or 10% increase, which in this market right now is actually pretty palatable and pretty normal. While home insurance seems to be going up at an ever-increasing rate, the reality is you definitely have some agency and some say-so in the situation. So take these 7 tips, apply them, save money, and make sure to leave a comment so I can send you a bill for all the money you saved. Thank you guys very, very much for watching, and I will catch you on the next one. Bye for now.